The German index remains supported by cooling inflation and expectations of a dovish ECB policy, with potential December rate cuts anticipated. Autos, banks and industrials are performing well, bolstered by improved sentiment on global growth and soft inflation trends. Risks include weaker German PMI data and lingering recession fears in the Eurozone, which could weigh on momentum despite technical bullish signals around the record highs. The Nikkei index is benefiting from strong foreign inflows due to a weaker yen and expectations of accommodative policies by Bank of Japan. Robust corporate earnings in tech and export-driven sectors underpin optimism, though challenges such as potential global economic slowdowns and domestic inflationary pressures may temper growth. G'day folks, welcome back to another update on the German DAX and the Japanese Nikkei. Before we go any further, make sure you hit that like and subscribe button to support the channel. Also, for some added benefits, visit the Patreon page, where each month for the cost of a cup of coffee, we scan bullish moving shares across global regions. Also, to learn how to draw the indicator shown in the video, follow the links in the description below. First, let's look at the German DAX on the trends on the monthly, weekly and daily. So here on the monthly first off, you can see here our CCI 150 is above its moving averages, giving us a bullish signal. And likewise, the price has been very bullish now since early 2023. Now, you'll notice as well on the long term, we do have a bearish divergence still in play, with higher highs on the price versus slightly lower highs on the CCI. Now, as long as that point there remains lower than that point, we're going to consider this a bearish divergence at the moment. But if that breaks higher than that point there, and it's considerably higher, even if it's equal, I'd consider it a bearish divergence as a double top. So it needs to break higher in the next few weeks or even months to invalidate the divergence. Looking at the weekly, now it's actually a fresh breakout to the upside above the moving average, a very narrow moving average range on the CCI, with the price as well giving us new highs. Now again, you'll notice we did have a few bearish divergence back here, and I've marked the targets with rectangles and a smaller one there. And we've got currently another one still in play between that point. You can see there between that point actually, the CCI dropping off to that point there, lower highs on the CCI, and that same range there on the price, higher highs on the price. That's a bearish divergence. Now for that to fall off, again, assuming it falls off from where it is at the moment, we take it back to the significant low, and that would be this point back here. So again, for those new to the channel, assuming it pulls back from where it is at the moment, we take it back to that point. So we expect it to reach in this 38% range, and I'll just mark it with it's a bit slow responding. Here we go. I'll just mark it with a temporary range of where we expect it to hit at the minimum. More than 90% of the time it hits this range. Now that's assuming it starts pulling back from where it is at the moment. This of course could keep rising, in which case we'd have to readjust these Fibonacci's. So I'll just keep it there for the moment, and we'll adjust it if necessary. That's on the weekly. On the daily, we have also all these divergences, by the way, on different time frames are independent. They're not related to each other necessarily. But here we've got another bearish divergence between those highs on the CCI and higher highs on the price. And again, similar sort of exercise. I won't draw the Fibonacci, but you get the idea. We expect it to pull back somewhere in this range should it pull back, and that would probably draw it back to that level there as a minimum. But at the moment, bullish movement on the CCI, likewise bullish movement on the price. It has hit this key resistance at 2380. So again, this could keep rising, of course, and so long as this CCI remains lower than that point there, we're going to consider it as a bearish divergence. At the moment, that CCI, you can see that it's slightly weakening, but again, nothing to get excited about yet to start drawing the divergence targets. If we look at the intraday, and you can interchange this with your own time frame, but I've got the 1 hour here. You can use the 2 hour, 4 hour, etc. But it's the same principle. We only take trades in the direction of the daily, of the higher time frame. So you would have taken trades back here when it broke above the CCI and the price. You would have gone long there, and I prefer to close it out when the price, when the CCI breaks into that moving average range, and then re-enter it again when it breaks above. And at the moment, you'd probably wise to, if you're trading this on the hourly in this case, you'd probably avoid trading this part here, because the CCI is telling you it's going to drop off with this bearish divergence. So yes, you would be missing out on this profit, but that's if you're trading on the hourly. If you're trading on the daily, you could, again, trading on the daily based on the weekly trend, you'd be in this trade still, and you wait for this CCI to break into that moving average range to close out your trade. But at the moment, be careful of this bearish divergence. If you're trading on the intraday, or the 1 hour in this case, we might see it pull back from where it is at the moment. A bit too early at the moment, but again, early signs yet. So here we've got the Japanese Nikkei. Again, we look at the trends first on the monthly, and the monthly is showing us a fresh breakout to the downside of the CCI. Even though the price is above its moving averages, I'd be cautious about going long at this point. That's showing a weakening sign, so we might see it pull back even more. We also did have a bearish divergence here, lower highs on the CCI versus higher highs on the price. And again, you would have been wise to have taken note there. Now, if I was to draw a Fibonacci, let me just expand that. If I was to draw a Fibonacci in the target range, there's a couple of things you could have done here. We would have taken it from that high to that significant low back there. And you can see there the 23.38% level was breached in this area here. It actually still fluctuated in that range for those months. So it's actually hit that as a minimum. Or even if you pulled it back to, let's say, take it back to that level there, another significant low, that's also been breached with these wicks in that range. So again, the minimum range has been hit a couple of times depending on where you draw the Fibonacci, typically the previous low, and that would have been that low there. So again, on the monthly, bearish move, and the CCI is still showing downside, even though the price is showing some slight bullishness at the moment. Now, if we go to that's the monthly. If we go to the weekly chart, again, a couple of divergence have happened here. That played out there, and we've got another bearish divergence here between lower highs there versus higher highs there. And again, if you used to draw a Fibonacci retracement for that smaller one, you take it back to that significant low, you can see there it broke it quite easily, and it actually broke down to the 61% level. This target range I drew earlier, that was based on, I think it was this point here. Let me just pull it back, or it might have been this one here. Yep. So that was that significant low there. You can see there it actually still hit that 23.38% level. So again, on the weekly, and you'll notice the CCI is still dropping. So that we might see further declines in the Nikkei on the weekly at least. On the daily, it's been fluctuating in this minor support resistance range. You'll notice the CCI is pretty much moving in line there. There's no divergence to talk of at the moment, so just be mindful of that. Probably take note of the higher time frame when trading this one on the daily. If we go to the intraday chart, again, you can still trade these smaller moves on the 1 hour chart or the smaller time frame. So that back there, for example, on that rise there, you could have taken it when the CCI broke above the moving average, going long at that point, and closing it out when it hit that moving average range there, and re-enter it again when it broke above the moving average range. There would have been a potential small loss, or even a break even at that point there. Re-enter it again at that candle, close it out near the top there. You can see what I'm saying. So you can trade with the direction of these moving averages, but you'll notice you get a lot more movement to the downside if it does move, whereas these ones give you a more closer exit to the top there when it does exit. Another entry there going long on that candle, and you would have exited when it broke the CCI into that point there, right on that red candle at the top there. So again, an easier and better profitability on that one. And since then, you would have avoided going long because the CCI was declining in a bearish move. Now, if you've noticed, we do also have a bearish divergence, lower highs on the CCI versus higher highs on the price. And the way you basically draw these is, once you see the CCI moving off, and you notice the CCI at this point, let me just get rid of this. Let me just draw it again. So the way you do it is, you start off, you notice the CCI there is dropping off, and so it is dropping off, and the price is also dropping off. So lower highs on both the price and the CCI. And then we move it further to the next point. So once you see the CCI start pulling back to the downside, at that point, you'll notice there, that's also that high there, lower high is also a lower high there. Keep going, and we take it to that point where it starts turning down again, when it starts breaking into that moving average range. Now this time you'll notice that the highs on the CCI are lower than the highs on the price. That's how you identify where it potentially will turn. Now this, of course, could have kept falling and the price could have kept rising, but as soon as you start seeing the price fall, in this case significantly below this moving average range, it did it once there, that could have been a false break, but you want to see the this ribbon band of the moving averages start turning down like it has back here, and that's where you know it's really pulling back in line with the CCI and giving us a bearish move to the downside. So what you do now in terms of targets, I don't trade the divergence. I actually use them as a warning sign to avoid going long. Once I start seeing this, I avoid going long at that stage. You can trade them, but it's a bit hard to sort of pick the entry, because you can see if you pull it back to that significant low, it actually come and touched the 23% at that point there, bounced, then it finally broke through to the downside, and this one's currently resting around the 38% level. At the moment, it looks like it's going to fall further because the CCI is showing no sign of a pullback. Of course, if we took it back to this level here, you can see there it missed it on that point on the 23%, but this one also broke through and is currently resting around the 31%, just below that, before the 38% level. So again, still a couple of ways of reading and anticipating the divergence. To support the channel more, hit that like and subscribe button and share the video. For added benefits and the cost of a coffee, consider subscribing to the Patreon page, where we look at weekly scans of bullish trending shares and insider trades that may have occurred. Thanks again, and see you in the next video.